All right, we're jumping right into a story that is literally unfolding as we speak. We're talking about a leadership crisis at the very top of the U.S. Federal Reserve. And I'm going to show you why this high stakes political drama isn't just news. It has some really profound, direct, and frankly, kind of dangerous implications for your own personal investments. Okay, so here's our game plan. First, we'll tackle this leadership vacuum at the Fed, what we're calling the headless Fed. Then, we're going to see exactly how that's causing a pretty scary rupture in the bond market. After that, we'll get into the brutal truth about what's really driving interest rates. From there, we'll look at the potential new monetary world under Kevin Warsh, and finally, we'll put it all together and figure out what it means for a strategy that goes way beyond your standard 401k. You know, this quote right here, it just cuts right to the chase. This isn't just some abstract power struggle in Washington. This is a direct threat to the stability of your retirement accounts. Your index fund? Yeah, it's sitting right on the front lines of this whole mess. So the big question is, how did we even get here? I mean, how did the most powerful central bank on the planet find itself basically paralyzed at such a critical time? Let's break down the players, the politics, and the whole saga. It really all comes down to this absolutely wild clash. You've got the Department of Justice investigating the current Fed chair, Jerome Powell. The official story is it's about cost overruns on a building renovation. But Powell himself has basically called that a pretext, a flimsy excuse for what he sees as political payback because he wasn't cutting interest rates fast enough for some people. And this whole investigation is crashing head-on into the nomination of the guy who could replace him, Kevin Warsh. And this is where everything grinds to a halt. The whole confirmation process is just completely gridlocked in the Senate Banking Committee. You've got the chairman, Tim Scott, trying to push the nomination through, but on the other side, ranking member Elizabeth Warren is leading the charge against it. And the real linchpin here is Senator Tom Tillis, who's basically said, I'm a no vote until this whole Powell investigation is sorted out. That creates a tie, and for now, the nomination is dead in the water. And you can see how this whole crisis just snowballed over time. It really started back in late 2025 with that political frustration over interest rates. Then, by January 2026, you had a totally separate Supreme Court case involving another Fed governor, which just threw more instability into the mix. So now, here we are, facing a blockaded confirmation hearing for Warsh, just weeks before Powell's term officially ends on May 15th. This is literally the roadmap to a headless Fed. Okay, so it's a political mess. Big deal, right? Well, what does that have to do with your money? Turns out, everything. This leadership vacuum is spilling right over into the bond market, the bedrock of our entire financial system, and we can see the cracks forming in the wild swings of the 10-year Treasury yield. This number right here, 8.3 basis points. This is the symptom of the disease, a sudden, violent jump in the 10-year Treasury yield. Now, in the normally sleepy world of government bonds, a move this big is like a fire alarm going off. It's screaming that there is extreme fragility and panic just simmering right below the surface. And this chart just shows the chaos in real time. Look at this. On April 17th, the yield hits a 4-week low. Everything seems fine. Then, just a couple days later, it spikes. And the trigger wasn't just the Fed drama. It was news of an Iranian vessel being seized, which immediately sparked fears of an energy shock and higher inflation. The market is just reacting so violently to news because its anchor, clear, steady leadership from the Fed, is completely gone. Now, this brings us to a super important idea, the liquidity trap. The best way to think about it is like a fire escape with a door that's been welded shut. In the old days, big treasury dealers were like the market's fire department. They were the shock absorbers who would come in and buy when everyone else was selling. But because of new rules, they just can't play that role anymore. So when panic hits and everyone rushes for the exit, there's no one there to provide capital. And this is what makes it so dangerous for your 401k. Your index funds are built on the assumption that you can always get out that door. But in a liquidity rupture, that door is locked. There were suddenly no buyers, and prices can just flash crash. And here's where the cold, hard math gets really scary. It's a concept called duration risk. All that means is it measures how sensitive a bond's price is to a change in interest rates. And for people holding long-term bonds, a strategy so many of us think of as safe, a sustained 1% rise in that 10-year yield would wipe out almost 9% of their capital. It's a slow-motion disaster just waiting to happen for anyone who thinks they can just buy the dip on bonds. All right, now we're getting to what might be the single most important part of this whole explainer. See, most of us, most investors, we believe that the Fed's higher for longer interest rate policy is a choice. But the brutal truth is, it's not. It's actually a fiscal necessity. The brutal truth begins with this monster number, $1.9 trillion. That's the projected federal deficit for 2026. That's how much new money the government has to borrow just this year. Now get this. Of that massive number, over $1 trillion of it is just to pay the interest on the debt we already have. Just let that sink in for a second. We're borrowing huge amounts of new money just to pay the bills on our old money. And all of this has pushed our total national debt to over 101% of the country's entire economic output for a year. The scale of this fiscal imbalance is just staggering. And you can see it right here. That interest cost has just ballooned. It's now a 14% slice of all federal spending. And here's the key. Unlike other government programs, you can't just decide to cut this. It's not discretionary. You have to pay your interest. The Treasury has no choice but to find buyers for its bonds. Period. So here is the bottom line, the big reveal. The Fed can't just decide to lower interest rates in any meaningful way. Why? Because the U.S. Treasury needs to offer high rates to attract enough cash from around the world to fund that $1.9 trillion hole. Higher for longer isn't a choice anymore. It's the price of solvency. The Fed's hands are completely tied by fiscal policy. Okay, so let's say he does get confirmed. What would a Fed under Kevin Warsh actually do? Well, his ideas represent a massive break from the past couple of decades. So much so that some people are already calling it the Warsh shock. I mean, the difference here is night and day. The Powell Fed was reactive. It waited for the data to tell it what to do. Warsh wants to be proactive, looking at trends. But the biggest, most important change is the main tool in the toolbox. Powell used guidance, right? He talked about what rates might do. Warsh wants to use active balance sheet reduction, also known as quantitative tightening or QT. This means the Fed wouldn't just let old bonds expire, it would actively sell bonds it owns back into the market. It's like taking a giant vacuum cleaner and sucking liquidity right out of the financial system. Now, here's the massive gamble at the center of the Warsh doctrine. He is betting that huge productivity gains from AI are going to show up and soften the blow of his policies. But there's a huge problem. So far, the data just isn't showing those productivity gains at scale. And at the exact same time, AI's unbelievable thirst for electricity is actually creating new inflationary pressures. So for your tech-heavy index funds, this is a total nightmare scenario. You get hit with high interest rates from the Fed on one side and soaring energy costs for AI infrastructure on the other. Okay, so we've laid out the whole problem. We have a headless Fed, a fragile market, and a high-rate environment that's basically forced upon us. So, what's the move? What's the strategic takeaway here? How do you even begin to navigate a world where all the old rules just don't seem to apply anymore? So what does this all mean for your actual strategy? Well, it kind of boils down to 4 new principles. First, you've got to reevaluate what risk even means. Sure, your 401k is diversified across different stocks, but it's not diversified against the system itself having a problem. Second, you have to hedge that duration risk. That 9% loss on bonds we talked about, you need a real plan to protect against that. Third, you have to prioritize liquidity. When those flash crashes happen, cash isn't just a safe place to hide, it's ammunition. It gives you the flexibility and power to act. And finally, you really have to think about rotating into real assets. In a world with huge fiscal problems and inflation, things like energy and commodities can actually become a safe haven because they can benefit from the very problems that are hurting everything else. And that really brings us to the final lingering question. For decades, the old model of retirement planning was really built on hope. The hope that markets would just always go up over the long run. But in this new world, a world driven by the brutal truth of fiscal necessity, hope, well, it's not a strategy. The real question you have to ask yourself is whether your plan is truly built for the reality of the world we're in now and the one that's coming.